Okay, so the past weeks we've been going over the options chapter, and we've just got a couple slides that I didn't complete that I want to talk about. Okay. So we talked about how it's a financial asset, the type of options there are, the type of assets it can be commonly traded on. Use of leverage in options, because the premium only represents a small portion of the total stock price. So instead of paying full price for one share of stock, you can pay just as little as 10% or lower to control a full share of stocks. Earning potential. We talked about there's a difference between people who buy option contracts, who buy calls and puts, compared to people who write the contracts, or sometimes called the seller, which is confusing to say seller, because you think that you're selling the option contract you bought, but that's why I prefer writer or maker. There's one person who creates the contracts, and another set of people who buy and sell the contracts. So one person writes and creates a contract, and it's sort of like they originate the contract, and other people trade the contract for profits later on. And the person who creates the contract gets a premium. He gets a premium. So you create the contract and he earns a premium as income, because he has a responsibility of fulfilling the contract if it's in the money and it executes. But the buyer of the contracts have no obligations to have to do anything. And the options are split up into puts and calls. And the disadvantages of options are that, you're not going to receive any interest or dividends from the asset, or have any voting rights on the asset, or have any ownership representation of the asset, and the option contracts expire. They're like coupons. They eventually expire. So you can kind of think as a coupon as a free option. You have the option to buy something and get 20% off for a limited time. Once the coupon expires, it's done. So if it was sort of, think of it like those coupon books. You spend $5, anybody ever come to your door, someone, annoying family member needs to sell these to stay in their soccer league, and it's a $5 coupon catalog. Well, you're paying $5 for the right to use those coupons, but they're for a limited time. Probably a year, so they can sell you next year's coupon catalog. And then you get this coupon catalog and you feel like, well, I paid $5 for it. I have to actually look for it and see if I can do something with these coupons to make it worth my while. So you wind up buying things or going to restaurants you didn't want to go to just to kind of get your money's worth, right? All right. So then we had a series of handouts. We had 4 handouts that discussed how you buy and how you could be a buyer, opening and closing positions as a buyer on contracts, puts and calls. And we talked about last class specifically, and the class before that, handouts on if you're the writer of these puts and calls, what your profits will be in different situations. If the stock price goes up, above the strike price, below the strike price, if you're the option writer, and how to benefit from that, we talked about. Now the textbook does have examples similar to the handouts. So if you found the handouts a little confusing, if you read a textbook, I try to stay close to the examples and the formulas in the textbook, so you can kind of reinforce some of the handouts through the textbook, as well as they're all backed up on Blackboard with answer keys that you could utilize as well to get an idea of how they're calculated. Okay. Now, as far as the final, there will be questions that ask you to calculate return on options. So remember, you want to look at the profits in relationship to the amount invested. You don't want to look at the return in the total value of the asset, because you don't really, even though the asset's worth, say, $100,000, you only invested maybe $10,000 in the money you spent to get that contract. So when you look at return, you always want to look at the profits you made, the straight up profits you made, plus the actual amount of money you invested. And for options, that's the premium. And you'll get a much higher return than this is actually investing in an option where you only pay $500 for the premium and you make a $2,000 profit. Here is investing in the actual stock where you invest $50,000. It's the same exact situation, except here the profits are $2,500 because there is no, you don't have to pay any premium if you just buy the stock outright. So some advantages of buying the stock outright over an option is that you don't have to pay a premium and there's no expiration. You can hold on to stock for as long as you want. So that's why some people prefer to buy stock rather than options, because it gives you a longer time frame. Although they do have what they call leaps, which are longer term option contracts. That could be a year or longer. Someone's getting text messages. It's not me, for a change. It's nowhere close to annoying as mine when mine goes off. So it's like very gentle ding.
Apple.
Okay, so let's move on. Okay, we talked about specifics of puts. I'm just, this is sort of a review of the options chapter. Okay, there are specific options exchanges that work like the stock market. So options don't trade on the stock exchanges, they have their own exchanges, but they work very similar to the stock exchanges. Okay. Now, something that's really, you need to get really clear in your mind is what the strike price is. And this is where some students have a difficulty. This is the contract price, and it doesn't change. That's the one thing you have to remember, the strike price does not change. It's written in the contract, and this is where you calculate the price you're going to use. One of the two prices you're going to use to calculate your profits, the other being the stock price. The expiration date is usually, options trade in weird cycles. There are 4 option cycles, and they expire the 3rd Friday of each month. And generally, most contracts are 90 days. So they have 3 expiration cycles, January, April, July, and October. So the options will be, and if your option contracts are in that cycle, new contracts will be written one of those months. Some stocks are so popular they run on all 3 cycles, so they have new option contracts every month. Some run on 1 or 2 cycles. And it's just the frequency of the contracts. For common options, they're generally no longer than 9 months. They could be 3 months, they could be 1 month, but we do have the leaps, which are the longer term options which you can get for years. They could be good for 1, 2, 3 years, and all options expire on the 3rd Friday of the month. And it would make more sense if they expired at the end of the month, but apparently there's too much paperwork and too much stuff going on at the end of the month, so they made it the 3rd Friday so they have time. This is back in the paperwork world, where now we're all computer, doesn't matter, but we're still stuck with the 3rd Friday. And they sometimes call it if different cycles of option contracts all come due on that Friday, they can call it like the witching Friday. So option premiums are affected by 2 elements, intrinsic value and time premium. So intrinsic value is the actual difference between the strike price and the stock price. Depends on direction of the difference, depends on put or call. But the intrinsic value is really, I have the right to buy it at $12 and the stock's currently trading at $20, $8 of intrinsic value. Very straight up answer. All remaining value of the premium, if your premium is greater than your intrinsic value, which it usually always is, the remainder is time value. And time value is sort of like a statistical probability of how likely it is for you to make money in the time frame the option contract still has left. The more likely it is for you to make profits on the contract, the higher the time premium will be. So if it's a stock that's very volatile, the time premium will be higher than the stock that's not very volatile. Because the odds, if the odds are greater you're going to make money, you're going to pay more for that option contract than the same type of contract for a stock or an asset who's not as volatile. So the time premium really has to do with the probabilities that you're going to make money with the contract. And the probabilities are always stacked in the favor of the person who writes the contract, not the person who buys the contract. So it's sort of the difference between going to the casino and owning the casino. If you buy option contracts, it's like going to the casino. And maybe your odds are, maybe you have a 45% chance of winning and the house has a 55% chance of winning. So the odds are in the house's favor. If you write the contracts, then you are the casino and you have a better chance of actually winning or making the money. That's why most experienced and knowledgeable traders write the contracts. They don't buy the contracts because it's more profitable on the writing side. So, okay. That's just a graphical example of put and call options. See how they're the inverse of each other? So they're the inverse of each other on the graph here, where profits for call options, the stock prices have to rise before you make profit. So here are the stock prices. The strike price is sometimes called the exercise price. And you can see that if this must have a $5 premium because the break even is at $55 a share. Then any price above 55 is profits on the option. So most options here would be operating at a loss when you first buy into it, and you have to wait for the stock price to rise on the call side. And on the put side, you're waiting for the stock price to fall. To make up, first you have to earn, the stock price has to fall enough to earn back your premium, and then which is your break-even point, which we see right here. And then as it continues to fall in the put contract, you make more and more profits. All right. And then we have these, the way to classify option contracts is in the money or out of the money. You can also say at the money, so the break-even point is at the money. Or at the money can also be where the stock price equals the strike price, can be considered at the money as well. But in the money is when your option contract's in the profitable area of that graph, and out of the money is when your contract is not in the profitable area. Pretty simple. All right. They do have a Black-Scholes model for helping the price options. These, again, this Black-Scholes model is for European options where they only expire, there's one expiration date. So the options, what's more important is the options price. What denotes the options price? When we're talking about the premium, the factors involved in the premium is where is the strike price? Because the strike price is going to be in relationship to the stock price. So the stock price and the strike price are going to tell you how valuable the contract is. The expiration date, the longer away, the farther away the expiration date, the more valuable the contract is. So if you had a contract that's going to expire in 30 seconds, not as valuable as a contract that's going to expire in 30 days. The rate of interest, specifically for contracts on option contracts related to bond assets, and also the stock's volatility, which I think is one of the most important factors, is the volatility of the stock. The past behavior of the stock has the higher level of volatility that stock has, the more they're going to charge in premium, because there's a greater chance that you'll make money with the contract on a volatile stock. Okay. As far as trading strategies with options, you can buy them for pure speculation. I think Apple stock's going to go up. Let me buy, one contract in Apple. So just pure speculation. You could buy them to hedge your risks. If you have a 1,000 share position in a stock, you own 1,000 shares, you could buy 10 put contracts to protect you if the stock price falls. So if you have 1,000 shares and the stock price goes down, now the put contracts will make up a high percentage of that loss you're experiencing with your real stock. If the stock price goes up, you just let the put contract expire and you've made money still. So this way, if it's a volatile market, if you hedge your positions of your stock with put contracts, you could take much less of effect of a downward bear market if it were to strike. But these are expensive, so you can't set up and maintain these positions continuously to always hedge and protect your assets, because it would be an extreme cost. You'd be constantly chipping away at your end profits. So generally the hedging comes into play when extreme market risk starts to develop. Sort of like you're getting close to a top of the market, or or the Fed's going to raise interest rates, or it looks like earnings are bad. These are things that you could start hedging your portfolios with. And there's one thing called spreading the options to enhance returns, and that would be part of the speculating of the options. So go over that in a second. The hedging of stock options I just explained, where you can take an opposite position in what you have, so that way if the market does change not in your favor, you can use the option contract to make up the loss you're getting in your actual asset. Okay. So we talked about the writing, we talked about the covered calls. One thing we didn't talk about is the spread. So we can do what's called a spread on an option contract, where basically we simultaneously buy a put and call contract. So we spread our contracts on both sides. How this works is, take, let's see, like that company we've been talking about some part of the semester, Lake, that makes the hazard gear that protects you from Ebola, and their stock's been very volatile. So I don't think the stock has options because it's so small, but if it did have options, you could buy a put and a call contract. So you know that within a month, either they've created a cure, a vaccination, or they didn't. Either way, the stock's going to move a great distance. So if they're able to make a successful vaccination, the stock will go down because you won't need as many hazard suits because they'll stop the spread of it. If they don't create the vaccine or determine they can't create a vaccine anytime soon, the stock price will go up tremendously. But you're not sure which one. Same thing for a pure play pharmaceutical company that has one drug in the pipeline, and the FDA is going to approve or disapprove of it in the next 2 weeks. Either the stock's going to double or be cut in half. So if you buy a call and a put position simultaneously, you'll make money either way, if the stock goes up or down. But it has to go up or down significantly to cover the cost of both option contracts. Because now you're paying 2 premiums for 2 contracts. You need extreme volatility on the up or down side to lock in the profit. So a spread is sometimes used on companies or even commodities. You could have done a spread in oil. So remember, in the beginning of the class, when we were talking about the virtual stock market, I've been telling you that oil prices are going down. Do you guys remember this? And then I bought solar companies because I felt that they would lose value as oil became cheaper and people didn't feel as much of a need to convert to solar panels. And sure enough, we started the class at oil at $100 a barrel, and now it's at about $60-something a barrel. So if I had been really smart, I would have made a spread contract, or even just I should have just bought put contracts on oil. And someone actually in the class asked me what you could do if you want to take advantage of falling oil prices, and I said you could buy put contracts on the oil ETF. If I wasn't sure, I knew the price of oil was going to go somewhere. Say we had just had that OPEC meeting, and that was going to be either oil prices were going to go down dramatically or up dramatically, depending on what OPEC does on that weekend meeting. You could have took a spread on option contracts on oil, and then you would make money on either of the directions. But you know that the direction is going to be volatile one way or the other. So that's sort of, these spreads, that spread's called basically a straddle, like a straddling a horse. You have one leg in both sides of the position. And it's just a strategy for making money with options. Okay. Option contracts, again, are commonly placed on indexes as well. So if you're a mutual fund manager and you fear for the return on your fund, you can buy options to give you temporary protection. If you're a more aggressive hedge fund, you can play options. So you could do a leverage type of fund where people invest $100,000, but you use that to leverage up to, say, $1 million worth of positions, so that way you have a 10 times factor return on these exchanges or indexes. So it's a way to leverage up. And there's a bunch of ETFs that have like sort of times 2, times 3, times 5 leverage. on certain indexes and averages. And how they do that is through option contracts or future contracts, which are also derivatives. Okay. And the index options work just like the stock options. They're just based on the index price. And of course, there are options on exchange-traded funds because they're just like stocks, and that's one way to play the oil. They have an exchange-traded fund that's tied to oil. Interest rate, you can do options on interest rates, the movement of interest rates. So if you feel that the Fed is going to raise interest rates next year, you could be buying option contracts that would take advantage of the increase of rates. There's also contracts on currency. The dollar is strengthening. If you feel like that's going to continue, you could get contracts on the dollar or contracts on the euro. You could buy put contracts on the euro if you think they're going to decline in value. And the leaps, we had talked about the 3-year contracts. Okay, so that's the total chapter 14. Just first part was a review. The end part was just going over a couple things I hadn't talked about previously. Okay. This is Windows 8, by the way. That's their, they have like a tile menu if you haven't experienced. Anybody want to take a tour of Windows? Okay. All right, so let's do the test review. So we have a big final exam coming up. It's on, I believe, 4 chapters. And it's going to be an online exam, like you've taken previously. 2.5 hours to complete the exam is the total time you have, which should be more than enough. And you can take it, you can start it anytime between 8 a.m., but you have to be finished by 11 p.m. at night. So if the latest you could start it and have the full time, I guess, would be 8:30 p.m. The final exam's on the same day as our actual scheduled final exam. So there's a 2.5 hour block of time that is our scheduled time for this class for a final exam within that day that we have the online exam. So if you have other exams that day, I'm not going to change the exam date because you have another exam. You do have another exam, it's at a different time than our scheduled time block. So there shouldn't be any conflicts, you know. And no one can have continuous exams from 8 a.m. to 11 p.m. on that day. So there's plenty of flexibility here. Now, the real challenge of the online exam is to have studied and prepared enough that you can complete the test in the time frame. If you don't do anything, don't read the chapter, don't attend class, don't do any of the class handouts, don't do any of the homeworks, you will have a very frustrating and experience trying to do the final exam. It'll just be a complete nightmare where you're just constantly trying to learn everything over the past 4 or 5 weeks here and compress it into 2.5 hours, learn it as you're doing the exam. It's not going to work out, which some of you learned through some of the previous, the midterm, the first exam and second exam. Okay. So let's go over the chapters it covers. Now, it's a the final exam will cover all chapters of the textbook. And we call that, what type of exam is that called? A cumulative exam. Oh, so no one has a problem with that? Okay, so I'll keep it as that. Oh, okay. It is. I was just seeing like how much spirit you guys had today if I just claimed it was, going to be every chapter in the test. And it really was such a lack of resistance that I'm surprised. You guys just rolled over and accepted that. Okay. It does cover chapters 8, 9, 12, and 14. So it's a 4-chapter exam. which I believe is the longest exam you've had. The other exams were 3 chapters. There's 76 questions on the exam. Some of them are really short questions, like true-false, and some of them are multi-part questions where it's one question, but there is one block of text, but it's for like 4 or 5 different mini questions. So don't let the number of questions completely strike fear in your heart. But it is comprehensive. It's pretty. I try to make it as representative of the material that we discussed in class, the class handouts, the homeworks, and the chapters that we covered, and the lectures. Okay, yes, question?
The multi-part question counts as one question? Or
No, it counts as multiple questions. So, okay. So questions about the final exam before I give you the topics on it, the specific topics. Okay. That's why I love Stony Brook. People just either are too afraid to talk or too smart. They know everything already. So either way, I'm fine with both. All right. These are in no particular chapter order. The test has a unique feature of scrambling questions and answers, as well as numbers on quantitative problems. So no 2 exams are identical. Although it would be a disservice to help each other, because the way I adjust the test afterwards is by how many questions the class gets wrong. So if there's one question that maybe is confusing or hard or just wrong, and majority of the class gets it wrong, I generally wind up giving those questions back to you. So if you're a really smart student and you want to help somebody else, you're really lowering your grade by providing anybody any additional help. So the worse the other students do, the better you'll do. Because it's not quite a curve, but there's a chance if you get the question right, and I do decide to give it back, you'll get double the credit for it. So there is a chance for some students, as in the previous exams, to make more than the points associated with the exam. And there's been a couple students who got above, say the last exam was 60 points, they could have got 61, 62, 63 points if they were that good at the exam. So there is a small, well, that's a minority of people who did that, but it's a possibility. I'm now going to be listing the subjects on the exam.
Are you going to put these on the blackboard or just typing them in?
I'm just typing it in up here. So you'll actually have to do a little work this class and take some notes. That's another thing I noticed is Stony Brook students aren't very keen on note-taking. And I can understand with the advances of technology, there's less a requirement for it. But there's certainly a certain amount of memory retention if you actually write something at the same time you're studying it. That if you ever actually read and outline a chapter and you write, kind of do a quick notes in the chapter, it's a good way to study for this exam. So as you read over the chapters, take notes in the chapter as you're reading it at the same time. It helps to reinforce, for you to pause and reinforce what you're learning, and then also a quick way to if you have to answer a question, you could go to your notes faster probably than the actual textbook. It's a hint, they're the same thing. These narrow framing, loss aversion, overconfidence, and earlier I had also wrote representativeness. Are all examples of behavioral finance terminologies you should be familiar with, which falls under technical analysis chapter. So there's chapter 8 has valuation models. They have the dividend models, like the constant growth model. We have price to earnings model. So there are a couple models in valuation from chapter 8. I'd be familiar with those formulas. What's characteristic of when the market has a high relative PE compared to when the market in total has a low relative PE? There's different characteristics of that. In chapter 8, we also talked about the capital asset pricing model. That's actually in 2 chapters of the book, but that's used as part of the valuation techniques as well. What's the difference between cyclical and defensive companies? How do mutual fund companies operate? What are their regulated responsibilities? How do they operate? How do they deal with capital gains and taxes and things of that nature? All from the mutual fund chapter. What is a socially responsible mutual fund? You being people under 30, hopefully have a stronger sense of what social responsibility is. And at the very least, you should at least recycle your bottles. If that's the least you could do. Just from a financial point of view, you don't want to be throwing out 5 cents every time you go somewhere, right? It's just a big... I average about $60 a year in return collections from the bottles I use. Or collect out of the garbage cans around here. Yeah, just there's a whole, if you ever need lunch money, there's a whole bunch of bottles in there you can return. If I don't get to them first. It's not for the money, it's for the social responsibility of the... EMH stands for Efficient Market Hypothesis, but it's just the acronym for Efficient Market Hypothesis. You know the difference between open-ended and closed-ended mutual funds and how to calculate the premium or discount. It's a question on volume balance, on balance volume. That's a technical indicator. you an example. This is a textbook, by the way, if you don't have it. It'd be a good time to get it before the exam. You can still get it online. I'm wondering if there's a relative strength index is on the exam. When I say market anomalies, things like calendar effect, the January effect, the small size effect, post-earnings announcements, these are all would be considered market anomalies to the efficient market. So look over that section in the technical analysis chapter. There's a question asking you to calculate earnings per share. But what they do, they do it in a tricky way. They give you some information, and you may have to use a little algebra to calculate the return, the earnings per share. Whisper numbers. As far as traders are concerned, how does the frequency of your trading affect your returns? A statement I had made in class about that. The advantages and disadvantages of mutual funds. There's a section that talks about the advantages and disadvantages. And that's going to be one of those questions that are Roman numeral 1, 2, 3, 4, and you have to pick the grouping of them. I know you hate those questions. So I'm just giving you just a little advanced warning on that. Remember when I was in school studying for finance-related tests, I used to actually try and make the test questions myself. And then try to convince the professor to use it as his exam. That part never worked out. But then later on, when I became a teacher in college, I used them then. So they actually did make it to become an exam at some point. I did that as a way to study. If you try to anticipate what the questions could be and try to make them yourself, yeah, I was an uber study nerd. Sorry. Okay, so odd lot trading and moving averages are on the tests. These are technical indicators. That's a formula or an indicator, the TRIN. These are all technical indicators. Overconfidence. How does it affect your performance in trading stock? Did that have any effect on how you traded in the virtual stock market? So would anybody feel at a certain point they got a little overconfident in their ability to make money in the virtual stock market and then took a position way too risky and then lost money when they were sure they're going to make money? Maybe you did? Yeah, it's an important lesson to learn in the virtual stock exchange with fake money. It's actually a good thing to make a lot of money, become confident, start taking risky positions, and then just one of those positions fail, it can wipe out all your profits for the year. Which is a good lesson to learn that's not your own money. The problem is sometimes people there's a syndrome, it's kind of attuned with speculation or gambling. If you ever, this happens in the stock market, happens a lot at casino too. Say you're playing, imagine yourself being 21 years old and going to a casino, or maybe you're at home playing with your friends, say blackjack, 21, and you're doing well, you start to win, but then you start to lose. And your bets when you were winning were $25 a hand as you're winning. Now when you start to lose, does your bets go up or down? The amount you're betting. They go up because you're trying to make back what you lost quicker. So you start taking bigger bets, and generally when you're on a trend, usually when you're gambling, there's uptrends and downtrends. There's a trend where you'll be winning more hands than losing, and there's a trend when you're losing more hands than winning. It's just statistical trends. Now, just think of that. You're betting less when you win, and you start betting more when you lose. What's going to be the end result of that? You're going to lose more. So what you should do, I don't want to teach you how to be good gamblers, but if you do find yourself in the casino, in the stock market, some people treat the stock market as a big casino. If you start losing, make smaller bets. And if you start winning, make bigger bets. Until you start losing, then make smaller bets. And you'll get out ahead. Remember, buy low, sell high.
Isn't there like a rule where you just double up and you keep doubling up?
That's the rule of losers, we call it. So you're losing, you lost your money, and you want to double up to try to get back to even or above, and then you wind up, that's how you go to the casino and come back with no money. Because at the end, you get really desperate, and then you put all your money on black or red, and then, of course, it comes up the other. These are lessons you'll learn when you start gambling, which I don't recommend. The logic you're describing is the logic most people have when they go to the casino, and that's why most people lose their money when they gamble. And it's also the common logic that you bring to the stock market is what brings most people to lose money in the stock market. So the way to make money in the stock market is to re-educate yourself and learn how not to invest as a consumer, buying things on sale rather than instead buying things that are a premium or that have value, that may even be overvalued. Because typically things that are overvalued continue to go up in value, and things that are undervalued continue to stay the same or go lower. And these are just your normal behaviors and your financial behaviors are working against you because your behaviors or your ideas based on your feelings and what you should do. Without education, you bring that to the stock market, you'll lose. So you have to re-educate your brain on how to trade and what your trading rules are for yourself and stick to them. It's sort of like if you never want to lose in the stock market or the casino, always quit while you're ahead. Like Kenny Rogers song, you gotta know when to fold them. I always remember there's a commercial where he's playing poker and the people around the table just get sick of him because he keeps singing that song. It's called YouTube People, look it up. Okay, page 18. So speaking of market anomalies, the small company tendency in January is specifically a question. What do they typically do? Should be familiar with the mutual fund loads and fees. What are, in the mutual fund area, also exchange traded funds. Be a good thing to know. Relative PE. Gotta get my grammar right here. What influences a company's stock price? What is it about a company that makes the stock price go up or down? Very basic question. You know, as far as cash flow, profits, leverage, things of that nature. Calculating option profits, know how to calculate, just like the handouts we did, how to calculate the profits from option contracts, whether you're writing them, buying them, whether they're puts or calls. So, when I say what influences the price of stock, it's actually a couple of questions. One might say what increases the price of the stock. One question might say what would contribute to decreasing the price of the stock. So just different scenarios companies can fall into. What is net asset value and how is it calculated? All right, so going through the test question by question, those are the topics I glean from the test. So those you should really have in your preparation bank as far as knowing these topics well, because a lot of these, the test is kind of split maybe 40-60, 40% quantitative, 60% qualitative concept types of questions. And the advice on the quantitative is, which I've been telling students all semester long, if you were in class, I was pointing out different things that you should definitely have formulas and prepared spreadsheets on. But the basic idea is that on the quantitative section, have your formulas ready and be able to identify quickly what formulas go with what type of questions. So when you get the inputs or the question, you can quickly calculate the answer without having to punch it into a calculator. Maybe you have a spreadsheet ready to go with the formula ready in there, ready to calculate, and you can get those answers much more quicker than if you have to actually figure them out. Or make sure you have a calculator handy or Excel open on your desktop so you could calculate things quicker and faster so you don't waste time on the test on the calculation questions. On the qualitative questions, the concepts, some of the questions, I've had this test made for a while, so I've been embedding a lot of the concept questions in the lectures. I know the lectures are kind of boring. I don't expect you to watch them a second time, or maybe even the first time for some people. But I did, if you were here during the class and were here live for those lectures, I did try to embed or focus on a lot of the conceptual questions and take a moment to describe them in detail in class. So you do have a basis in them. But some questions, the trickier questions, they made laser focus in on one particular sentence or two in the textbook. That just is a sentence that's a fact. that the better you know the layout and the landscape of the textbook by reading the chapters, hopefully at least once, preferably twice, you have an idea of where to go to quickly to get to that specific information. Because I think the real challenge to this test is to complete it within 2.5 hours. If you've done your studying and if you attended class and you've done the homeworks and the classworks, you should have no problem completing it on time with proper study. If you're going to face the test with a lack of preparation or study, it may be a challenge to finish on time. So I think that would be, for most of you, that's your probably biggest enemy. All right. So now that I've laid out all the topics of the tests, and I emailed you and posted an announcements when the test is. And remember, it's just like the other test. You go to the homework manager, and it'll appear on the day it's supposed to appear. So you know that drill. But are there any other questions about the final exam that I can answer? And just let me tell you, I can only answer these questions in the classroom area. I can't answer them during office hours or through emails or any personal exchanges after class. So if you have a question now, now's the time to ask it.
Some of the past practice tests had like present value questions, but it never showed up on the actual midterm. And then like a few weeks ago, there was a homework about present value also. So will that be on the test? It takes a while.
Yeah, no, I didn't see any present value questions on the test. I was going through. Now the present value, I wanted that in the homeworks because that's a reinforcement. You should have learned that in 330. And the present value is related to some of the dividend models. They have some present value in it. So it's always good I wanted you to reinforce it, but I don't feel I should have to test you on it. So that's a really example of a really great question. Thank you for that. Anybody else? Any questions about anything? It doesn't have to be the test.
Can you just go up a little bit?
Sure, of course. Oh, by the way, I'm not going to post this on Blackboard, but I will post a lecture on YouTube if you want to go back if you missed anything on this.
Right before.
If it processes properly, because sometimes it fails in processing. Let me start.